Welcome, dear traders. Inflation data published last Friday may be a turning point in the Fed's monetary policy. Judging by inflation figures, the prospects of a hard landing look more real. Analysts are trying to figure out whether the Fed will announce more aggressive monetary tightening this week. Let's discuss the main events of the Asian session. Following the release of the US inflation data, the stock market saw the steepest drop since October 2020. Although traders were expecting a further rise, there were little hopes that inflation had already reached its peak, so they were hoping to see a moderate slowdown. Those hopes evaporated when the CPI index for May reached a new 40-year high, climbing to 8.6% in annual terms. On a monthly basis, inflation advanced to 1%, and this report revealed that the regulator might take more aggressive measures to tame inflation. It means that new rate hikes are likely to take place in June, July, and September. Some analysts believe that the Fed may raise the interest rate by 75 basis points at its Wednesday meeting instead of the previously announced 50 basis point increase. The Nasdaq index looked the worst weekly performance since January 2022 due to soaring inflation. The US Treasury yield curve also drifted higher, with the two-year Treasury bonds testing a high of 2007. US stock indexes closed last Friday with a sharp decline of 3%. The Nasdaq index fell by 3.5%. Usually, when investors abandon risk assets, the high-tech Nasdaq sheds the biggest losses. On the chart, we can see how Wall Street sentiment has changed during this year and how bearish it's now. It appears Monday may become another day of losses in the stock market. US stock futures are extending the three-day losing streak that started at the end of the last week. Asian stock indexes are also down due to Wall Street pessimism. Besides, stock markets in Asia are facing risks of the inflationary shock and China's never-ending struggle with the coronavirus. Safe haven assets are winning in favor with investors amid surging consumer and energy prices, as well as the risks of a slowdown in the global economy. As it turns out, US inflation has not peaked yet. On the contrary, it has accelerated. The US dollar index approached a two-decade high on Monday amid inflation fears. In the Asian session, it reached 104.63. Expectations of a more aggressive stance on a monetary policy boosted the US dollar against its main rivals. The US dollar index kicked off the week with a rise, trading in the Asian session in the range of 104.21 and 104.75. Whereas major central banks have already hiked the key rates or are about to do so, the Bank of Japan stubbornly maintains its ultra-loose monetary policy. It's unwilling to make some adjustments even despite a sharp fall in the yen. The regulator keeps the interest rate unchanged at minus 0.1% and the yield of 10-year government bonds near the zero level. Last Friday, both the Japanese government and the central bank expressed their concern about a drastic decline in the yen, and they make a joint sentiment quite rarely. So investors hoped that the central bank could intervene to support the yen. However, traders did not count on such a scenario after a sharp increase in the US Treasury notes. The yen is quite vulnerable to the rally. It's hardly surprising that the US dollar has climbed against the yen, as the Japanese government bonds are below zero and the US bonds are above 2 or 3%. The yen on Monday hit a 20-year low against the US dollar, and some analysts reckon that the dollar-yen pair may decline further to a level where there are no clear targets above a high of 2002. So traders should pay attention to the levels like 136, 137 and 138 and so on. However, let's not forget that in case of a recession in the United States, the safe haven yen may edge higher. For some investors, such a signal came last Friday with a higher-than-expected inflation figures on a month that the yen partly recovered its losses against the US dollar, moving in the range of 134.11 and 135.19. When making the video, the yen-dollar pair took a nosedive to the level of 134.36. While the yen has finally got the chance to add gains, the Aussie is losing momentum. Trading floors in Australia closed on the occasion of the Queen's birthday. Global concerns about interest rate hikes are fueling demand for safe haven assets, and the Aussie is very sensitive to risk appetite. This is why it's now losing luster with investors. Apart from risk aversion, oil prices have decreased as well. China maintains lockdown restrictions in some areas to curb coronavirus spread. The Australian dollar slid to 0.6984, the lowest level in 3.5 weeks. During the Asian session, it was trading in the downward channel between the support level of 0.6981 and the resistance level of 0.7050. And that's all for now. Subscribe to InstaForex TV channel and keep close tabs on market developments. Feel free to leave your comments down below and see you soon.